So, you want to build a $1 million portfolio? Well, this is the episode for you. Welcome to Get Started Investing, a podcast where we cover everything that you need to kick off your investing journey. Today, we're unpacking the question, how can I build a $1 million investment portfolio? And it isn't as hard as you think. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited by that intro. Very intrigued.
A lot of $1 million portfolios in there.
We've got a listener question around building a $1 million portfolio. It's a dream that we all strive to achieve, and we're going to cover off how we can do that with ETFs and what specific ETFs we might be putting in that portfolio in this episode.
Love it.
Let's kick it off with the question. This comes in from Jasmine.
Hey Bryce and Ren, I've been loving the ETF series. What are your picks for building a big portfolio for a long-term horizon? I've started investing this year at 23 and I want $1 million portfolio by at least my 50s. Help.
Love it. Help. We hear your cry of help, Jasmine.
Okay.
Thank you for the message.
Yeah, thank you for the message, Jasmine. If you want to submit your question, there's a link in the show notes, or you can go to equitymates.com/contact. We love your voice notes, so please keep recording them.
Yeah.
So Bryce, let's start with the goal and then work backwards from there.
Yeah.
Is becoming a millionaire realistic?
Yes.
Cool.
Next question. So the answer is yes, but we should try and put some numbers around it to illustrate how we're going to do this. So if we're working backwards, what we want to do is look at the $1 million as the goal and then figure out over that time period, let's say Jasmine wants it over the next 30 years. She's 23 by the time she's 50. We need to determine what rate of return per year we need to get to that $1 million. That's how we're going to do it.
So when it comes to building wealth, there's really three levers that we can pull. There's the amount that we invest, each pay cycle or whatever, the rate of return on our investments, 6% a year, 10% a year, whatever it is, and then the amount of time we allow our investments to compound. That's the most powerful of the three, but Jasmine has limited us here. She says she's 23 and she wants to be a millionaire by 50. So we've got 27 years to play with.
Let's go. Good amount of time, I would say.
Yeah, definitely.
Absolutely.
What we're going to discover is that it is not as far-fetched as you think.
No.
So we've got two levers to pull. The amount we can invest and the rate of return we can get on those investments. So Jasmine didn't tell us how much she can invest. So we've kind of done a bit of scenario planning here. And the thing is, you do need to invest some money to get to $1 million. Like, we're not going to be able to say $2 a day.
No.
Yeah. So we've said if Jasmine can invest $100 a week, if you put that in a Money Smart compound interest calculator, she needs about a 13% return over 27 years to get to $1 million.
Yeah, which is not crazy.
Yeah, well, I'll show you how not crazy it is. But if she can bump that up over time and get it to $200 a week.
Yeah.
Now that might feel a little out of reach for some people at this time, but you slowly do it over time. Don't spend your pay rises when you get them, and you invest more and more. $200 a week, your rate of return required to get to that $1 million over 27 years, 8.5%. So that means we're looking for investments or ETFs that range between that 9 and 13% per year return.
Which, if you are a long-time listener of the show, is good news, because you would have heard us say time and time again that range is the range that the market averages over 100 years.
Well, yeah. If you're not a long-term listener of the show and you're new to the show, welcome.
Good
what an
news
episode
for you,
to
baby.
join. Let me give you some of the numbers that illustrate that point. So we've got data from America and Australia for this. In Australia, with dividends reinvested, since 1900, the stock market's average return, 13% a year.
Wow.
That's
so
123 years of proof. If we travel over to the US, since 1926, the S&P 500, which is America's 500 largest companies, with dividends reinvested, 12.2%.
There you go. So just to remind ourselves, we were looking for a return of between 8.5% to 13%.
Yeah,
so
depending on how much we're investing.
Depending on what we're investing. If you're doing the $100 a week, both of those markets, Australia and US, more than adequately cover that.
Not more than adequately.
Adequately cover that.
Well, no, the
US doesn't quite cover it. Falls within the range.
But yeah, I think the point is that like we're playing the right pool. Is that the analogy?
Yeah,
We're fishing in the right pond.
It's not unrealistic.
Yeah.
So the second question then, Ren, is becoming a millionaire even a good goal?
Yeah.
Is this just something that we perceive we need to be? Like the $1 million feels nice. It's what aspirationally it's good, but is it worth it?
It's a nice round number as well.
Yeah, it's a nice round number.
So I guess the good news is you don't need $1 million. So it would be nice, but you don't need it. And don't take our word for it. Take the Australian Financial Security Authority's retirement standard as the point of truth here. They say that for a comfortable retirement, a single person needs $595,000 and a couple needs $690,000. Now, those numbers are going to inflate over time. By the time we retire, or by the time Jasmine's in her 50s, they will certainly be higher because of the cost of inflation. They will unlikely to be doubled, though. It's not going to go from 595,000 to 1.1 million.
Yes.
So I think having $1 million is a good goal to strive for. It's not an unreasonable target. Like, it's an achievable target if you get your investment habits right while you're young.
Yeah.
But if you go for that goal and you don't hit it, you're still going to be more than adequately set up for retirement based on these numbers that we get from the AFSA.
Now, Ren, it's important to note that there are many ways that you can make money in the stock market, and there are
even ways outside of the stock market.
Even ways outside of the stock market. There are plenty of different asset classes that you could try to get to this goal.
Yeah.
Try and use property, for example.
Yeah. Generations of Australians have
killed it.
Yeah, tried
Absolutely
to get
killed
this
it.
with property.
Alternative assets, bonds, individual stocks, for example, even just creating a portfolio of individual stocks. There are many ways and different asset classes that could get you to the $1 million, but we don't think it's the best way. We think the best way is through the ETF structure.
We think if you sort of did the combination of the historical growth and growth potential, the cost to access in terms of fees, the amount of money you need to get started, and just the ease of access, like the amount of time that you need to spend to do it, we think the ETFs are like a really great way for people to start building long-term wealth. And so that's why this episode is best ETFs for, and that's why we're talking about it here. But it's worth acknowledging that, like, if you love property, then like you can also pursue that goal that way, as long as you're thinking about like the rate of return that you need after fees and after costs of property and settlement and all that stuff.
So let's get stuck into it.
It's not complicated.
It's not.
3 points criteria. First of all, are they designed to be truly long-term investment products? And for us, that means, are they index ETFs?
Yeah.
And if that's a new term for you, we'll include a couple of links to episodes in the show notes where we really unpacked why we think index investing is so great on the Equity Mates podcast feed. But that's the first one. Are they long-term index products? Secondly, are they diversified? And we mean here, are they global? Are they exposed to the global stock market, not just, the Australian stock market? They're not diversified across asset classes, but that's okay for what we're trying to do here. And then finally, are they low fee? We, as a rule of thumb, we sort of want to see an ETF with less than 50 basis points of fees. But these days you can find them less than 30 or 20, so lower is better, obviously. But there are 3 points.
So with that criteria in mind, I think, Ren, how many? There's 352 ETFs listed on the Australian Stock Exchange alone.
Numbers are out of date. 375.
375. Wow. Yeah. So there are dozens of ETFs that actually fit the criteria, but we are going to discuss just a few that we think most appropriately match it. Now, we're going to break this down into categories because there are different ways you can approach it. There's the true global index products. There's some that have like a quality focus. And then if you want to take a bit more risk, we'll talk about the leveraged ETF options, because we know that there are a lot of people in the community who are starting to pay a bit of interest around leverage.
Yes.
So let's start with the global index products.
Yeah, now these are the only products that truly fit the criteria we were speaking about. And we'll get to why the others don't quite, but these ones tick all 3 boxes. And so some of the ones that you might have heard of, the Vanguard Global, which is VGS, the Vanguard Diversified High Growth, which is VDHG, or the BetaShares Diversified High Growth, which is DHHF. So there's 3 ETFs that you can go away and do your research on that meet our criteria. But the big question is, do they meet the return goal that we set at the beginning of this episode to make Jasmine a millionaire by 50. So here are the numbers of these ETFs since inception. So since they started, these are their per year returns. DHHF, about 11.5%. VGS, the Vanguard one, 13%. VDHG, 9%. So they're all sitting in the range.
Absolutely sitting in the range. The second bucket is a quality focus. Now, these are ETFs that don't necessarily truly follow an index, but they have a tilt towards companies that are defined by investment managers as better quality.
Yes.
And these are very popular ETFs. There's nothing wrong with them, but they just are not set up as a true index-style ETF.
I mean, there's a lot right with them.
Absolutely, a lot right with them.
Know how they're different.
Yeah. So there's three. There's the MOAT, M-O-A-T. There's QUAL, Q-U-A-L, and IOO. Now, do they pass the test when it comes to total returns? MOAT, since inception, has returned 15.8%. QUAL is 16.4%, and IOO 16%.
Yes.
So well and truly.
So they all surpass Jasmine's hurdle.
Yes.
Yeah.
Should be getting to 1 million by 48.
So I think there's some great ETFs to look into as well, that if you want to just be dollar cost averaging over time. And then you said the third bucket was the potentially a little bit spicier, a little bit more risk bucket, and that was, can we add some leverage to these ETFs? Now, we've pulled out 3 ETFs here that are listed in Australia. One of them meets our 3-point criteria that we spoke about before, and that's GHHF, which is the geared version of
the spicy uncle.
Now, it's super new. It's been around for like 3 months. So we don't really have any historical performance data that's meaningful, but it is globally diversified. It is an index product, and it has a fee of less than 50 basis points. Its fee is like 0.35%. So that's one you can look at, and 2 others that don't quite fit our criteria because they are country specific. There's BetaShares Gear and GGUS, which follows Australia and the US respectively.
Yeah.
Now, GGUS has returned 18.4% a year, Gear 10.5%. So, again, the returns are sitting in that window or above that window that Jasmine is ticking and saying, okay, $1 million is realistic, again, depending on how much she's investing each pay cycle. But I think there's, how many have we done? 9 ETF names that you can look at. Importantly, you don't invest in all 9. I think that's probably where we want to finish it. You don't want to become a collector of a lot of ETFs. 1 is enough.
Yes.
If you want 2, you want a global index and then maybe a quality one on the side, that's absolutely fine. Or a global index and a leveraged one with a bit of a smaller portion of your money, that's fine. But like 1 or 2 is all you need. And then it's just about good money habits.
That's it. It's just about grinding, setting and forgetting, to be honest. Automate your investment strategy as much as possible. Put it away. Put as much money into the market as you can. Don't stress about it if that $100 turns to 50 and you can't make it every single time. We know life happens, but
so if that 100 that you're investing each fortnight turns to 50,
no.
Not if you're investment hard.
Yes.
Even still, it's like the market will fall at different points.
That's right. That's right. But look, I think the most exciting element for me here, Ren, is that it is possible for Jasmine, it is possible for you and me and many of the other Equity Mates listeners out there to truly build a $1 million portfolio without having to pick a single individual stock and without having to spend worlds of time doing it.
Yeah, and I think for me, when I first got this question, when I was a new investor, I would think to become a millionaire, I would need something spicy or, fast growing. I'd need like some crazy small cap or some crypto or something like that. But what we've learned over this journey is that consistently investing, taking the market average return, and just giving yourself time to grow, they're the ingredients to become a millionaire.
Absolutely.
Not some wild and crazy investment strategy.
No.
Yeah.
So Jasmine, thank you so much for your question and suggestion. If you have a question that you'd like us to answer, leave us a voicemail in the Equity Mates mailbox. The link is in the show notes. We love hearing from you. So whether it's an investing question or something that you've learned along your investing journey, send it through so we can share it with the rest of the Equity Mates community. But Ren, as always, an absolute pleasure. we'll pick it up next episode.
Sounds good.